Picture this. January 15th, 2026. Seoul, South Korea. You're sitting in the conference room at the Bank of Korea headquarters. Governor Ri Chang-yong is about to announce the policy decision. The won is trading at 7-month lows. Housing prices in Seoul climbed 9% last year. Household debt keeps rising. Your economy needs stimulus. Lower rates would help. But there's a problem. Across the Pacific, the US dollar is strengthening. If you cut rates now, capital flees. The won weakens further. Inflation accelerates. You're trapped between domestic needs and external pressures. So you make a choice. You hold rates at 2.5%, a fourth consecutive meeting with no change. But that's not the remarkable part. The remarkable part is what you say next. You remove the language about future rate cuts. You signal the easing cycle is over, not paused. Over, you just chose currency stability over economic growth. You prioritized external pressures over internal needs, and you're not alone. The same calculation is happening simultaneously in Beijing, Frankfurt, and Washington. Central banks that spent 2 decades moving in coordination are now moving in opposite directions, each prioritizing local survival over global stability. This isn't policy divergence. This is monetary fragmentation. And history shows us exactly where this leads. When central banks stop cooperating and start competing, when coordination breaks down into every nation for itself, the system doesn't adjust gradually. It breaks suddenly. We're watching the coordination that prevented the last crisis dissolve in real time. The question isn't whether this ends badly. The question is how fast it unravels. 1. The Fed under siege. The United States Federal Reserve. For decades, the Fed has been the anchor of global monetary policy. When the Fed moved, other central banks adjusted accordingly. Not because of formal agreements, because of mathematical necessity. The dollar is the reserve currency. Fed policy determines global liquidity conditions. Other central banks had to respond or face currency crises. That system is fracturing, not from external pressure, from internal attack. The independence of the Federal Reserve, the principle that kept monetary policy insulated from political interference for generations, is under direct assault. President Trump has been publicly criticizing Fed Chair Jerome Powell for months. The criticism isn't subtle, it's explicit. Powell is too slow to cut rates. The Fed is damaging the economy. Changes are needed. May 2026. That's when Powell's term expires. That's when the president can nominate a replacement. Markets are already pricing in the possibility that the next chair will be more politically compliant. Someone who prioritizes short-term political objectives over long-term stability. This isn't speculation. This is stated intention. January 13th, 2026, 2 days ago. Something unprecedented happened. Christine Lagarde, president of the European Central Bank, issued a public statement, not a routine press release, a solidarity declaration. On behalf of the ECB Governing Council, she stated, "We stand in full solidarity with the Federal Reserve System and its chair, Jerome Powell. The independence of central banks is a cornerstone of price, financial, and economic stability. This has never happened before. Central banks don't issue solidarity statements unless the threat is existential. They did it because they recognize what's at stake. If the Fed loses independence, if monetary policy becomes subordinate to political cycles, the entire architecture of global finance loses its foundation." François Villeroy de Galhau, a member of the ECB Governing Council and chair of the Bank for International Settlements, went further. He stated explicitly that attacks on Fed independence threaten the dollar's role in the global economy. Not might threaten. Threaten. Present tense. Happening now. When the world's reserve currency becomes a political instrument rather than a monetary one, every holder of dollar assets must reassess risk. Every central bank holding treasury securities must recalculate whether those holdings are safe. The ECB's vice president added context. He stated that the paradigm has changed. The attitude of the United States is different. Europe must become more independent in defense, cloud services, artificial intelligence, and global payment systems. Translation: we can no longer assume American monetary policy will prioritize global stability. We must prepare for a world where the Fed prioritizes domestic politics over international cooperation. This is the psychological inflection point, the moment when confidence in the system's anchor begins to crack, not because of economic data, because of political interference. When central banks globally start questioning whether the Fed can be trusted to act rationally, they must adjust their own policies defensively. That adjustment creates the fragmentation. 2. The China contradiction. The People's Bank of China announced in early January 2026 that it will implement an appropriately loose monetary policy throughout the year. They pledged to cut the reserve requirement ratio and interest rates flexibly to maintain ample liquidity. The language was explicit, moderately loose. Countercyclical adjustments, support for domestic demand. But here's the contradiction. As of mid-January 2026, they haven't actually cut yet. The one-year loan prime rate remains at 3.1%. The 5-year rate that anchors mortgages stays at 3.6%. Both rates were last reduced in May 2025. Since then, nothing. They've been pledging cuts for months. The cuts haven't materialized. Why? Because China faces the same trap as South Korea, but at a larger scale. The yuan has weakened nearly 2% since Trump's election in November. Trump has imposed tariffs of 20% on Chinese imports and threatened more. If China cuts rates aggressively, the yuan weakens further. Capital outflows accelerate. The currency crisis that Beijing spent years preventing could reignite. So they're stuck. The domestic economy needs stimulus. Property sector remains depressed. Retail sales growth is slowing. Industrial output is below expectations. Consumer price inflation actually turned negative in February for the first time in over a year. Producer prices remain in deflation. The economy is screaming for monetary easing. But external pressures make easing dangerous. The result is targeted intervention rather than broad easing. China isn't implementing economy-wide rate cuts. They're using surgical tools, reserve requirement reductions for specific sectors, directed lending to small and medium enterprises. This is the monetary equivalent of triage, treating the symptoms most likely to cause immediate political instability while avoiding actions that could trigger currency collapse. This represents a fundamental shift in Chinese monetary policy. For 2 decades, China operated with a simple framework: maintain currency stability, recycle trade surpluses into dollar assets, keep domestic rates low enough to support growth, but high enough to prevent capital flight. That framework assumed cooperation with the United States, assumed that Fed policy would remain predictable, assumed that trade relationships would remain stable. All 3 assumptions are breaking simultaneously. Fed policy is becoming unpredictable due to political interference. Trade relationships are collapsing under tariff pressure. The old playbook doesn't work anymore. China is improvising. And when the world's second largest economy starts improvising rather than executing a coherent strategy, systemic risk increases exponentially. Analysts are now predicting that if domestic data doesn't improve, China might cut rates as early as April. But the prediction is conditional. If retail and home sales don't improve, if inflation stays weak. These are reactive triggers, not proactive planning. China is waiting to see how bad things get before acting. This is crisis management, not policy leadership. 3, the Korean capitulation, the Bank of Korea decision. All 34 economists polled by Reuters predicted no change. They were right. Rates held at 2.5%, but the forward guidance changed dramatically. Previously, the BOK statement included language about maintaining a rate cut stance. It said the board would decide whether and when to implement further cuts. That language is gone. The new statement simply says monetary policy will be determined by comprehensive assessment of inflation, growth, and financial stability risks. No mention of cuts, no directional bias. The easing cycle that began in October 2024 is over. The BOK delivered 100 basis points of cumulative cuts over several months, then stopped completely, and now they've signaled they're done. The reason is explicit. Currency stability. The won touched 1,470 against the dollar in recent sessions. Authorities spent over $2.6 billion in reserves on intervention. The impact was minimal. The won keeps weakening. If they cut rates now, the selling pressure intensifies. So they chose to defend the currency rather than stimulate the economy. This decision has consequences. The BOK revised its GDP growth forecast for 2026 to 1.8%. That's below the economy's potential growth rate. They're accepting slower growth to prevent currency collapse. They're prioritizing external stability over internal expansion. 10 years ago, this decision would have been unthinkable. Central banks coordinated to maintain both currency stability and growth. Now they're being forced to choose. The internal dissent is telling. The policy decision wasn't unanimous. There was one dissenting vote. The same dissenter as the previous meeting. Opinions on whether to cut rates in the next 3 months are divided. Support for easing dropped from 4 members to 3. The consensus is fracturing. Even within the same central bank, there's no agreement on the correct path forward. Reuters poll data shows the shift clearly. In November 2025, over 60% of respondents expected at least one additional rate cut in the first quarter of 2026. The latest poll shows only 22% expect a cut this quarter. The next predicted cut has been pushed back to the first quarter of 2027. That's a full year away. In 5 months, market expectations shifted from imminent easing to prolonged pause. South Korea is a middle power, not systemically critical like the US or China, but it's a leading indicator. When a well-managed, relatively stable economy like South Korea has to choose between growth and currency defense, it signals that the pressures are becoming universal. If Seoul can't maintain both objectives, neither can anyone else. 4. The fragmentation. Endgame China pledged to ease, but hasn't because of currency and tariff fears. South Korea just signaled the end of its easing cycle to defend the won. The ECB is holding rates while warning about risks from American policy. Every major central bank is prioritizing local concerns over global coordination. This is the pattern that precedes systemic crises, not policy divergence. That's normal. Different economies require different policies at different times. This is fragmentation, the breakdown of cooperation, the abandonment of coordination, the shift from collective stability to individual survival. Look at the historical precedents. 1997, Asian financial crisis. Thailand's currency peg broke. Contagion spread to Indonesia, South Korea, Malaysia. Why? Because once Thailand moved to defend itself, every other Asian central bank had to do the same. Competitive devaluations, each nation trying to preserve export competitiveness by weakening their currency faster than their neighbors. The coordination that might have contained the crisis to Thailand disappeared. The result was regional collapse. 2008. Lehman Brothers failed September 15th. The global financial system froze. Why did a single investment bank failure trigger global meltdown? Because central banks weren't coordinating effectively. The Federal Reserve, European Central Bank, and Bank of England were pursuing different priorities. When Lehman went down, there was no coordinated response ready. Each central bank scrambled independently. The lack of preparation turned a contained failure into systemic crisis. The difference this time is that the fragmentation is happening before the crisis, not during it. In 1997 and 2008, coordination broke down after the shock hit. Now it's breaking down in advance. Central banks are pre-positioning for conflict rather than cooperation. They're building defensive capabilities, hoarding reserves, preparing for scenarios where they cannot rely on support from other central banks. China accumulating gold at record pace, not for returns, for independence from the dollar system. South Korea choosing currency defense over growth, not because the economy is strong, because they don't trust external stability. The ECB warning about American policy, not because of economic data, because political interference is making the Fed unreliable. When central banks stop trusting each other, they stop coordinating. When coordination ends, the buffers that absorb shocks disappear. A problem that would have been manageable with cooperation becomes catastrophic without it. The Thai baht breaks. Without coordination, contagion spreads. Lehman fails. Without coordination, markets freeze globally. The next shock, whatever it is, hits a system with no coordination infrastructure intact. The mechanism of modern financial crises isn't the initial shock. It's the absence of coordinated response. 1929. Banks failed across America. The Federal Reserve didn't coordinate a response. They let the banking system collapse. The Great Depression wasn't caused by the stock market crash. It was caused by the policy fragmentation that followed. Central banks pursued contradictory policies. Some maintained gold standard discipline, others broke the peg. The lack of coordination turned recession into depression. We're watching the same pattern develop, not in response to crisis. In anticipation of it, central banks see the fragmentation coming. They see political interference threatening the Fed. They see trade wars fragmenting global commerce. They see currency pressures forcing defensive positioning. And they're choosing individual survival over collective stability. The timing is critical. Markets are near all-time highs. Volatility is low. Credit spreads are tight. Surface indicators suggest stability. But underneath, the architecture is fracturing. Central banks are the foundation of market stability. When the foundation cracks, the structure above doesn't adjust gradually. It collapses suddenly. The Bank for International Settlements, the central bank for central banks, has been warning about this. They've published research showing that when monetary policy coordination breaks down, the probability of financial crises increases dramatically, not linearly, exponentially. The system is designed for cooperation. When cooperation ends, the design fails. We're at the inflection point, the Fed under political attack. China trapped between domestic needs and external pressures. South Korea choosing currency over growth. The ECB warning publicly about American unreliability. Every major central bank operating independently rather than cooperatively. This is how the coordination that prevented the last crisis unravels. The crash doesn't come from economic weakness. The data might look fine until the moment it breaks. The crash comes from the absence of coordination when the shock hits. And the shock is coming. It always comes. The only question is whether central banks will respond collectively or individually. Based on current positioning, they're preparing for individual survival. That preparation guarantees collective failure, because modern financial systems are interconnected. A crisis in one market spreads to all markets. A bank failure in one country triggers contagion globally. The only defense is coordinated response. And the coordination infrastructure is dissolving right now, in real time. While markets assume stability will continue, The monetary arms race isn't about which central bank cuts rates faster or holds longer. It's about the breakdown of cooperation. It's about each institution prioritizing local political survival over global systemic stability. And history provides a clear verdict on what happens when cooperation ends. The system doesn't adjust. It breaks, suddenly, completely, with consequences that last for years. January 2026, the Fed under political siege, China promising easing that doesn't arrive, South Korea ending its easing cycle, the ECB issuing unprecedented solidarity statements defending Fed independence. These aren't isolated events. They're symptoms of systemic fragmentation. The architecture that prevented the last crisis is coming apart. The next crisis will find a system with no coordination, no cooperation, and no collective defense. The warning signs are flashing, not in market prices, in central bank behavior. When the institutions designed to maintain stability start preparing for individual survival, the collective system is already failing. The crash isn't coming despite central bank actions. It's coming because of the absence of central bank coordination. And that absence is happening right now. If this type of analysis helps you understand what really drives the markets beyond the headlines, leave your like below. Comment on what you think about this fragmentation of central banks. And share it with anyone who needs to see it, because the lack of coordination between the Fed, PBOC, BOK, and ECB is not a conspiracy theory. It is a fact documented in official statements from January 13th and 15th, 2026. When cooperation between central banks ends, crises are not long in coming. See you in the next video.